Then in part B, determine whether Jane's Preserves will generate sufficient cash to pay Jane a salary of $42,000 per month during the first year of operation. All right, so over here, guys, it's important to note we already know during the first year that the company is not going to sell enough units, or they're selling less than their break-even point. So if variable costing is used, we can see that they're actually forecasting a loss. Now, if you just look at it like that, you can say they definitely don't have enough profit available to pay Jane's salary because they're forecasting a loss. But if you read the required here carefully, we are not talking about profit over here. I want you to determine whether there will be sufficient cash to pay Jane's salary. So the reason why I've included this in the required is to make sure that you guys understand the difference between cash and profit. So that's why this is very important. Okay, so we are trying to determine whether the company is going to have enough cash to pay Jane's salary during the first year. So we are trying to calculate the cash profit or loss, which means we should only take cash flows into account in this calculation. So we're going to take into account sales, we're going to deduct all of our variable costs, and we're also going to deduct all of our fixed costs. But everything must only be cash. If there's something that's non-cash, so for example, the first thing that pops to my mind is depreciation, then obviously that shouldn't be taken into account in the calculation because it's not a cash flow. All right, now instead of taking sales and then deducting variable costs, you guys know that sales minus variable cost is contribution. And in part A of the required, we did already calculate contribution. So it's going to be much quicker if we rather just start this calculation with contribution and then deduct fixed costs. Okay, so let's first start with the calculation of contribution, making sure that we only take cash flows into account in our calculation. Right, so if you just go back to part A of the required, we did calculate the contribution per unit for each of the products. So there's your contribution per unit. Now, guys, we don't really know the nature of all of these costs. So unless you can clearly see something's not a cash flow, it's safe to assume that it's a cash flow. So all of the sales over there, it's safe to assume that that's a cash flow unless you're specifically told otherwise. The same logic applies to the variable manufacturing overheads and the variable marketing and admin costs. We don't know exactly what's included in all of those amounts. However, based on the information provided, you can't say this is not a cash flow. So we have to assume that all of these are cash flows, okay? So they don't just affect profit, but also cash. Then if we want total contribution, we obviously need to multiply the contribution per unit by the number of units. So for jam, they expect to sell 39,600 units, and for chutney, they expect to sell 20,700 units. So using that information, we can calculate total contribution. Okay, then let's calculate our fixed costs. All right, and we did also calculate total fixed costs in part A of the required. So you'll remember we had product costs and we also had period costs. So there's the total fixed costs. Now you just need to look at what goes into the calculation of fixed costs to make sure that we are only taking cash flows into account in our calculation. All right, so the salaries will be an actual cash flow. The company actually has to pay the salaries. It's important to note, guys, though, in all of these fixed costs over here, Jane's salary has been included. So you can see 40% of Jane's salary has been included in salaries over here, and 60% of Jane's salary has been included in marketing and admin costs just below. So this does already include Jane's salary. I'll come back to that right at the end. Factory rent, that's obviously also a cash flow. The company actually needs to pay it. Depreciation is not a cash flow. Think of your journal entry, you debit depreciation, you credit accumulated depreciation. You're not debiting or crediting bank anywhere. So that is not a cash flow. So it needs to be excluded from our fixed costs. So let's first process that adjustment over there. So start with total fixed costs that we calculated in part A. Okay, we need to exclude depreciation because that's not a cash flow. Okay, let's see if there's anything else. Then other fixed manufacturing overheads. So we don't know what's included in that calculation. You can't just exclude it unless you specifically know that it's not a cash flow. So it's safe to assume there that that is a cash flow. The same logic applies to marketing and admin costs. And the same logic also applies to finance costs. These are all cash flows. However, you just need to be careful, guys. When it comes to the loan, the company is not only paying finance costs. So there we have the finance costs on the loan. The company is not only paying finance costs in the first year. They also need to pay some capital on this loan. Because in note 4, you were told that the loan bears interest at a rate of 9% per annum and is repayable in 5 equal annual installments comprising of interest and capital. So we've taken the interest into account in the calculation of fixed costs, but we haven't taken the capital into account in the calculation of fixed costs. And the logic behind that is when the company repays the capital on the loan, they are going to debit the loan because they're reducing the outstanding amount of the liability, and they're going to credit bank. So the reason why we didn't take this into account when we calculated the break-even point is you can see this is not an expense that affects profit or loss. On the other hand, interest is an expense that affects profit or loss. We debit interest expense. Sorry, I don't really have enough space over there. I'm trying to squish it all in. For interest, we debit the interest expense and we credit bank. So because interest is an expense that affects profit or loss, it was taken into account when we calculated the break-even point. However, the capital repayment of the loan does not affect profit or loss. You can see we debit the liability and we credit bank. There's no impact on profit or loss. So this wasn't taken into account when we calculated the break-even point correctly. It shouldn't be taken into account when we calculate the break-even point. Because when we calculate the break-even point, we only take into account income and expenses that affect profit. This doesn't affect profit, so it wasn't taken into account. However, it is important to note that this is a cash flow. So it needs to be taken into account if we're trying to determine whether the company has enough cash available to pay Jane's salary during the first year. So let's have a look at this as a separate calculation over here. Okay. What was the original loan amount that was on the first page? Okay, because she's going to purchase state-of-the-art machinery costing 350,000 Rand, which was financed with a loan from her commercial bank. So the loan amount is 350,000 Rand. So the present value is 350,000 Rand. N is going to be 5 because the loan is repayable in 5 equal annual installments comprising of interest and capital. The interest rate on the loan is 9%, so I is 9%. The future value is 0. We don't have a bullet payment at the end of the period. The loan is repaid in equal annual installments comprising of interest and capital. So if you compute the payment amount, that will give you the interest and capital that's being repaid on an annual basis. Okay, well, that will have to be repaid on an annual basis. So that includes both interest and capital. Now, you just need to be careful. Included in these total fixed costs over here, we have already taken the interest into account. We have interest of, or finance costs of 31,500 Rand. So what you can do is obviously you can take this amount, you can deduct the interest because we have already taken that into account, and then just make sure that you add the capital amount to your fixed costs. Or, as an alternative, an easier way to perform the calculation is to exclude the interest, because we know included in this calculation of fixed costs over here, we have finance costs of 31,500. So take those finance costs out and instead include the total loan installment. And that was calculation 3. We have an amount there of 89,982. Sorry, that should not be deducted, obviously. It should be added to our fixed costs. Okay, we're excluding the interest. The interest has already been taken into account in this amount. So exclude the interest, otherwise we're double counting for the interest, and instead include, so add the total loan installment, because the total amount is a cash flow. So guys, like I said, as an alternative, what you could have done is you could have said, this is the total cash flow, take out the interest amount, that will then give you the capital, is obviously just the balance, and then just to your fixed costs over here, just add the capital amount. But however you perform the calculation, you'll come to obviously exactly the same answer. All right, so that gives us our total cash fixed costs. Right, so if you perform this calculation, you'll see we have a loss there of 39,562. And you'll remember I said to you, it's important to note that the total fixed costs over here already include Jane's salary. Part of her salary is included in that amount over there, and the balance of her salary is included in that amount over there. So in this calculation, we have already taken Jane's salary into account. So taking Jane's salary into account, we can see the company is going to make a cash loss of 39,562 Rand. So that means they won't have enough cash available to pay Jane a salary of 42,000 Rand a month during the first year. So make sure that you actually answer the required and just conclude. Okay, so if it's a salary of 42,000 Rand a month, that is an annual salary of 504,000. Okay, what is the shortfall? They will be short 39,562. Okay, so what they will be able to pay Jane is 504,000 minus 39,562. That's what they can afford to pay her in cash. All right, so that then answers part B of the required.